So, welcome to Money Discourse, where good news is bad news and bad news is terrible news. What have we been seeing this week? Material risk to the UK financial stability. Are we seeing a Great Depression coming? We've seen a massive crash in stocks. We've got Cathy Wood writing an open letter to the Fed saying it's making a mistake in its hardline stance against inflation and risking economic bust as it's looking at backward and lagging data. Rajan, what is going on?
I did say in the last pod we did that I remain very bearish. Like you just said, all the news, whether good or bad news, just has a negative impact on this market right now. And on a market point of view, it's just a very grim time. And I mean, you talk about a crash. It's actually worse than a crash right now. It's slow bleeding. And that's the worst type of down market you can get. In a way, if the crash happens, it's done. It's like a shot to the arm. And then afterwards, you get some type of bottom, and then you might round off and then go higher. But the thing is, right now, we're just slowly just dripping every week. And I mean, we've had 5 straight down days in the NASDAQ and the E-minis. The Dow actually eked out a small gain today, which was nice for the Dow. But I mean, it's not really a barometer of the overall basket of stocks. But we actually seen the opposite action to what we normally see when we're running up. So last Monday and Tuesday, we had 2 gigantic rallies in the market, which is a bit of the inverse of what we normally see in a sell-off, where we have 2 massive declines and then everything just sort of peters back out. But what we're seeing now is the big fat rallies, and then things take their normal course of action and starts coming back down again. And the thing is that we've seen all these companies all talking about problems. AMD, they cut their guidance, talking about a massive fall off in PC shipments, which is the lowest they've seen in a long time. And that saw AMD last week go down about 13%. And that brought down all the chip makers with it, along with NVIDIA. And then we having the US government meddling in the chip space, putting restrictions on chip sales to China. That is also causing so many issues with Taiwan Semiconductor down big today. We had KLA Tencor. They had issues too. They got the message from the US government. What did they actually say? So, so basically KLA Tencor said to stop some sales and services to China, including to China-based customers such as South Korea's SK Hynix and chip plants owned by Intel, to comply with the US export curb. So seeing headlines like that just ain't giving any positivity to the market. And it's just not good for world trade. And China not, innocent in this whole thing, but this is going to be a big problem, So even Samsung reported that they missed on their earnings, although they showed growth, but they missed their estimates. So I mean, it's just all the data is just bad right now. And really, the only saving grace we got coming ahead is this Thursday, this CPI reading. And in fact, last month's CPI reading is the one that came in 0.2 hotter than expected, and that was the start of the massive downturn we've had. And now, could it be the opposite? But I just don't know right now. What are we expecting? We're expecting 8.1% after we got an 8.3% on the headline reading last month. So if we get 8, or even optimistically, if we can hit a 7 handle, we will get the biggest rally. We could get 1,000-point plus rally in the Dow if there's some signs of slowing inflation on this reading. So Thursday is going to be a huge day, but if we don't come, and if we come in stronger than expected on Thursday, we've got another 20% to the downside. So it's going to be a big one this Thursday. I feel like that is the only green shoot that can come out from what seems to be a very negative couple of weeks right now.
The real question is, how much of this is already priced in now? Have we had just a massive dump as the market tries to price in all new level of multiples that need to be attributed to all these equities? And then are we running from a kind of reset from there?
Yeah. I mean, to be honest with you, this move let's have a look at the chart, what we've been getting. And I mean, if you look at from literally mid-August, we're at 4,300, we're at 3,600 now. So that's a 700-point drop, which is just shy of 20% decline in the space of just over a month and a half, or just over a month and a half. So in a month and a half, we've dropped almost 20% in the S&P 500, which is insane. And the thing is, no matter, this has just killed all the, all the levels. It's held for a while, but it just sliced through them. This is the bit which I was mentioning before. That was your 2 big candles on the back of last week, but we got given them all back, and now we're back, pretty much back at the low seen last week. And in fact, the NASDAQ took out last week's low. So NASDAQ hit an all-time low. I mean, recent all-time low. So the thing is that if we look just against charts, I mean, we're in this channel going downwards. As you can see, we've got an up and bottom line that this chart seems to be adhering to quite well. And if we keep on going lower, we're looking at about 3,400 is next. But I mean, if we can break out this 37, if we can sort of consolidate or even just bounce a little bit and go above 3,700, then I think maybe we can sort of find a short-term bottom. Well, everyone's trying to find a short-term bottom now because, you know, the velocity of this drop has been so large, but not in an aggressive way, which is the most worrying thing. As you can see, these bars, apart from this massive down move, and this was in fact the last CPI reading we had, that's a huge move lower. But if you actually look at the level of the bars, they're generally quite small. We had two big green bars, but again, just drip, drip, big down day that day, drip, drip again. And it's just a slow downward grind that we're getting, which is the hardest to defend against because it just, you don't get that much bounce in half of these stocks or anything like that. So, I mean, again, you saw the size of the bar that we got in the last CPI reading. So if we get another reading 0.2 higher or lower, we're going to see it maybe potentially a similar type of bar. Because the one thing that has not changed right now is the Fed and all the central banks' rhetoric towards inflation. There is no letting up. We had non-farms last week, and non-farm payrolls actually came in, pretty all right. It came in line with expectation, and that is just giving all the catalyst that is needed for the Fed to continue on their rate path because the labor market is still strong. It's pretty tight, and so in their eyes, the economy ain't imploding like maybe is necessary for them to sort of slow down in their rate hiking path. And in fact, this is actually the most aggressive rate hike cycle that there has been in, a multi-decades, the rate at which we're going. And we're looking at another 75 basis points again from the Fed right now. So you're looking at this, we're right now smack bang in the middle of this downward range. So, technically we can still got another 150 point downside or upside right now, depending on what the numbers come up. And like I said before, this AMD, that they're really pushing down on the semiconductor space. AMD actually cut their guidance by from the midpoint over $1 billion. Now they're expecting third quarter revenue of 5.6 billion. That is well below the 6.7 billion estimate, and that led to that 13% decline in AMD. And it said macroeconomic conditions drove lower than expected PC demand and significant inventory correction across the PC supply chain. So it's seeing this across the board, really. So I mean, this is the thing. So it doesn't look like this is what we're in store for when it comes to this earnings season. We're going to see all the banks, all of them reporting earnings next week, and then we're going to see them coming thick and fast. And the question is, how is the market going to take it? Because I feel like you said, what has been priced in, the market has priced in pretty much negativity in all of these reports. So I think any company that just showing slightly above, less than, just something better than what the market's expecting, actually showing a few green shoots, showing some decent demand, then maybe we might get isolated stocks going higher. But in general, the trend is still down. So this is where we stand right now.
In the deepest recessions, there's always the stocks that outperform, or meme stocks. You're going to see all of that stuff continue, but just to a much lesser extent. Oh man, it's not just the crypto winter. No. It's everything winter at the moment.
It's a global asset winter.
Yeah. Exactly.
I mean, we've got to such a point that Cathie Wood is right next to the Fed. How desperate. Yeah. Our fund managers right now.
I mean, she's not wrong in what she's saying. You know what's just so crazy is that last year when we saw inflation kind of start popping up, the Fed were like, oh, no, there's no problem here. Everything is all good. We don't need to start tightening. If they just did start raising rates a small amount back then, we could have quelled this type of inflation much earlier. But now this is all kind of manufactured by the Fed in a way, because they just they printed all this money, right? And saying, oh, there's no inflation. Right now we're getting inflation. They're like, okay, now we want to kill the economy. And now if you think about it politically, Biden's getting up to the midterms, all of these voters with any kind of like a pension, any 401k or any investment into the markets, equities, what they're going to be thinking, is Biden a good president? They say the Fed is independent from whoever's leading the country. But the thing is, Biden took him to the side and said, look, I'll hire you. And obviously they had some words, but obviously it means that, look, you're only going to get a job if you do what I say. And whoever's pulling the strings there seems like they want to see Wall Street suffer. And this is exactly what's happening.
We actually had comments from the Swiss National Bank's Jordan, who's the head of the Swiss SNB. And he actually goes that central bank independence is being threatened by political factors. And he's going as hard for the political entities to stay out of what's supposed to be independent operations of these central banks due to what's going on right now. And the thing is, if you just look at everything, adding on to your point, all the problems we got right now are actually man-made problems, right?
Yeah, meaning Fed-made problems.
Yeah. Fed-made problems, war problems, chip problems, everything is like, the whole movement around a free trade, that's going out the window. So much protectionism here and there from everywhere in the world. No one area is immune to criticism. You have oil. And now the US is saying that they might not sell arms to Saudi Arabia. They consider Saudi Arabia as a friend. They go delay this oil cut, or we consider you as a ally to Russia. So the thing is, you've got Saudi and OPEC cutting oil production by 2 million barrels per day, but that we mentioned last week. And then again, just leaving this easy policy on for just so long, even though things were coming up and just that word transitory, it's just transitory, and not able to recognize that the massive shift of what COVID done to the overall supply chain, which I guess many people could have seen. And so all of this is just man-made. It's sometimes you just need to let the free markets do its thing, but it's just so much meddling, intervention doing this. And just like what we had in the UK, we're having these massive tax cuts. Gilt markets go crazy. Pension funds are in trouble. The Bank of England buying back gilts, and now they're going to start their quantitative tightening. So the thing is that they've got the government and the Bank of England doing different things, and they're trying to shore up the market. Their gilt yields are going through the roof. I mean, just everywhere. It just seems like a big fat mess from all the people in power that just have no idea what the hell they're doing as things are going crazy. And I'm not saying it's an easy job. I'm not saying that that someone else could do much better, but it's just so much wrangling, so much meddling in the overall market forces that are just causing all of this.
The question is, what is more of an evil? Like having inflation, obviously you can see it's coming down in terms of commodities, and obviously we've gone into this in detail in previous pods. But is it do you want to just crash the economy? Because obviously that's the trajectory that they're going on right now. Is that what is more preferable to the leadership?
The Fed stance is inflation is basically the devil's head, and that high inflation will cause much more worse outcome in the longer run than taking the hit short term. And I think from our point of view, we're thinking about markets, but you look at just the average Joe, everyone what they're talking about, and it's these prices.
But raising rates, do you think that with financing costs and all of that stuff, do you think there's going to be just magically decreasing prices because obviously food and oil, is it going down? Like they're raising rates, is food and oil going down? I don't know. Yeah.
My issue is not the rate rises, it's just the pace at the rate rises. I feel like the thing is by doing 75 basis points and then doing another 75, doing another 75, it's gone at such a quick level that you just haven't allowed anything to sort of set in stone. There's been no gradual runoff. We've seen mortgage rates go from 3% to 7% in the quickest time in history, pretty much. Yeah, the rate at which the mortgage rate 3 to 7%, it's just nuts. And it's just crazy. You might be looking at a house, and 1 week later you think, all right, let's put an offer in, and then next thing you know, it's gone up 1.5%, the rate on a 30-year or a 15-year. And the thing is that, but my hope is they want to get to this level, what they call neutral, 4.5%. And like we spoke about before, the dot plots are slightly above that right now. But I think if we get to 4.5%, that would imply a 75 basis point hike in the next meeting, and then a 50. And then do they stop? Do they just calm down? Are they going to go to 5, 6, 7? When they don't see inflation coming down as fast as they want. The way all these central banks, they have the same rhetoric. It's like they've all been in a meeting together. They want to front load the rate hikes, and then afterwards get it at this level, and then stop and then see what happens. So this is their way of doing it, but in terms of doing it, it's just going so quick, so fast that I think that a lot of these companies, everyone has just been taken aback, and even people. And again, I was saying this to you earlier when we spoke before. In the US, you're insulated a little bit by some of these massive rate hikes because you have 15-year or 30-year fixed. In the UK, it's mainly 2 and 5-year fixed. So the amount of people that are going to be rolling off these 2-year fixed mortgages, and next thing you know, they're going to be looking at some 6, depending on a 2-year rate right now, you're looking at 5 to 6.5%, depending on where you look. And it's going to be a massive sticker shock. That could really cause some havoc, especially in the UK housing market and just the UK economy as a whole.
Loretta Mester had some hawkish comments, basically just saying what she had said before. The only thing they care about right now is just continuing raising rates to quell inflation.
Looking at these Mester comments, I'm just going through some of them. Right now.
She was saying that
she basically reiterated that the Fed will not cut rates at all. in 2023. So she said back on the 6th of October, and then today she reiterated that facts, but she did also say she's yet to see any progress on inflation. So, I mean, to be honest, all the Fed rhetoric and all the rhetoric in general from all the central bankers they're repeating the same thing every single week. It makes me a bit worried. The fact that she said that they're not seeing any progress yet, and the inflation rate, the inflation numbers in 2 days' time, have they already got it? And is it still going to be an 8.3 number, 8.2? Because I guess, that is something that could have freaked out the market, because, the Fed, I'm presuming, already knows what the inflation number is in a couple of days. And the fact that she said they're not making any progress yet on inflation suggests that this number is likely not to be a good one, what the market needs. And I think that's why the market, in a way, might have sold off a bit on that as a precursor to that Thursday number. So that could be a bit, that could be, that could be something that was looked into by the markets on that. And I hope she's just saying it in general, but if she has got that number, then, that's not good, because we had 8.3%, we're expecting a 0.2% decline, but is it going to be still above 8%? Well, judging by those comments, taking into the fact that she might have seen them, that would be a problem at all. But in terms of just how, what's the best way to play this market right now? Like, what do you do? I mean, I've seen many around me, and I guess the most prudent way to do it, rather than selling off, is to hedge your portfolios with, like, going long SQQQ or some of these inverse Russell or NASDAQ E-mini contracts. So there's a lot of people that hedge in their portfolio 20%, 30%, 40%. But I mean, it's a tough one. It's a tough one right now in terms of what to do, because we've come off so much. And then if you really do think we're going to see a bounce, I'd rather put on that hedge on a bounce rather than while we've come 5 straight sessions lower, Exactly. But in terms of, it's been a bit difficult one to play. I mean, a lot of my option plays is taking out the downside. There's no real defense for it right now. When you have moves from AMD literally from 70 odd to 56 in a week, Nvidia dropping to 113. We've seen Tesla literally go from 290 to 215 in a couple of weeks. How do you even defend against that? It's just
exactly. Because if you haven't actually deployed your cash and you're sitting on the sidelines and you're scared to get into the market, remember, this is a less risky time than this is a much less risky time than if you were buying, just a month ago. Sometimes you have to cut the noise, because there's always some war going on. There's always some trade war. There's always some kind of thing going on. Obviously, there was COVID that hit, which was obviously a massive shock to the whole economy. But obviously, then we had the Fed behind us. The biggest thing right now is we don't have the Fed. We have the opposite of that, and also we have quantitative tightening for the first time in mass.
Yeah, but I mean, what it is everything psychology right now. So we, the mindset of people when we're going up in a straight line, and I remember actually saying this. Sometimes I remember in the peak euphoria last year, when you had 100% gain, it wasn't enough. I want 150. I want 200%.
Yeah, exactly.
How much would you kill for 100? I'll kill for a 20% gain right now. Yeah. Exactly. But in that type of market, your whole thing is like, oh, this can go up 300%, 500%. And the thing is that you have the fear of selling because 100% ain't enough, 50% ain't enough. And right now you've got the fear of holding because you're 50% offside or 30% offside. And it's amazing how people don't want to take their profits, a lot of them, when they're 50%, 100%, 150% onside, because they got the fear of missing out on the next 200% move. Yet when it goes down, it's the fear of just losing even more. It's just crazy how the psychology works. But the whole point is, when you see these moves upwards, that's when you should be taking profits, and just always be trimming. And then when it comes in like this, you just gently add if it's something you can do. But again, for me personally, I'm pretty much fully deployed now, and there's very little to do. Otherwise, my kid's not getting Christmas presents, So it's a tough time. I mean, I have to save a little bit of money for that, So it's a tough one. But we're coming, to conclude this. Let's look at this inflation. So, what's your prediction for Thursday? This is basically the run up we've had. Like back in the middle of June, this was obviously peak COVID time. We're virtually at 0%, and we've seen this steady rise. And we peaked at 9.1. The last reading we had was 8.3. And again, our expectation this time is 8.1. So we're expecting a decline of 0.2. And month on month is expected to go up 0.2. from last month. So, but you can see the trajectory is down, and we want to continue seeing it come down. And like I said in the last pod, as the months go on, the comparables are going to get harder and harder to see it. A continued 8% rise. We are naturally going to go down because you're talking about huge, massive high inflation come the end of last year, beginning of this year, and especially coming into March, April, May, June with a big rise in oil. So I think naturally we will come down, but the question is at what pace, and what pace is good for the Fed to see. But I mean, looking at these Mester comments, I got a feeling that we're going to remain at about 8.3, 8.2, which would be slightly above expectations, which doesn't bode well. And I hope I'm totally wrong, but that's my guess.
I'm really hoping that we have some kind of respite, at least for a couple of days, just so we can sleep a little bit well. I would say definitely it's been a very, very stressful time, even though, you're looking at the portfolio and like, I'm not going to sell this anyway, but just seeing the numbers go down, you're like, holy crap, even like my wife doesn't really care about all that. She's like, what? Tesla's at 250. Oh my God. It's like, the opposite when your barber would be talking about stocks, this is like the opposite. It's like, oh my God. We just all have to question how much of this is priced in already. And then like, I'm not saying we're going to be at lows, anytime soon, but, are we just going to be getting these dramatic drops like we've been getting, like for the 5%ers and, a day? Are we going to start seeing that? Or are we just going to start seeing like a very small trickle down? And because there's going to be a certain point in time where people are just like, you know what? I've seen enough pain as it is, and I'm just happy to, because it all comes down to capitulation. Right? When it's and so like they're like, oh my God, things are dropping so fast, but then after a while, you become so immune to it that you don't see that same type of capitulation, and then these guys just thinking, okay, well, whatever's going to happen is going to happen. I'm just holding on, and then that I'm not saying that day is going to come anytime soon, but it's going to come sometime, but you just have to wait.
Well, I think at 8.1% number, if we come in line with expectations at 8.1, we'll rally big. But anything above that, 8.2, especially 8.3, if we're flat on a year-on-year basis, we're going to sell off big. But if we do come in at 8.1, I think that will be good for the markets, and we will get a rally, especially given the price action prior to this. I wouldn't be surprised tomorrow if we have another down day coming into that CPI number. And again, if we can come in line with expectations, it would be great. I think it would be a great move. But again, that'll probably only eradicate a couple of days worth of losses at best. But we'll see. That is the big catalyst coming ahead. You can see a lot of positioning around it. And that's it. But we'll see. We'll see how it goes. We'll analyze the CPI number on our next pod, see how it all went down. But until then, if you liked what you heard, please like and subscribe. And we'll catch you on the next one.